Welcome to AM Best Audio.
Welcome to this AM Best briefing. Global Reinsurance, January 1 renewals and 2026 market outlook updates. I'm John Weber. Over the course of the next hour, AM Best analytical staff, along with reinsurance market executives, will examine the evolving global reinsurance landscape and provide an update on our global reinsurance outlook. The panel will share perspectives on the 2026 outlook and reflect on themes emerging from the recent renewal season. The conversation will also touch on broader market developments, strategic considerations, and the forces shaping reinsurer performance in the year ahead. We're going to meet our panel in just a moment. Now, we may mention the subject of financial strength ratings. A full explanation of AM Best ratings can be found on our website at ambest.com. The opinions expressed by our non-AM Best panelists are theirs and theirs alone and do not necessarily reflect the opinions of AM Best. And now let's meet our panel. First, we welcome in Aditya Dutt, President, Elis Capital Management Limited. Aditya, thank you so much for taking the time to speak with us today.
Hi, John. It's a pleasure to be here.
Next, we say hello to Renaud Guédet, CEO, AXA XL Reinsurance. Renaud, glad you could join us.
Thanks, John, for having me. Pleasure to be with you.
Last but not least, we have Greg Dickerson, Director, Global Re-Analytics, AM Best. Greg, is always great to see you.
Thanks, John. Happy to be here.
And Greg, we're going to kick things off with you today. And this briefing comes on the heels of AM Best revising its outlook on the global reinsurance market segment.
Yeah, thanks, John. Yeah, so we did revise our outlook for the global reinsurance market to stable from positive earlier this week. And maybe I'll just start with a very quick summary of what led us to assign a positive outlook to begin with. So our outlook has been positive, or had been positive, since June of 2024. And that was actually the first time we'd ever had a positive outlook for the sector. And what led us to assign that positive outlook was that after a period of several years prior to 2023, where reinsurers posted lackluster results that generally failed to cover their cost of capital, there was a true market reset at the January 1, 2023 renewal period, which reflected real market dislocation at that point in time between reinsurers and ceding companies. Losses from Hurricane Ian, which hit Florida in the second half of 2022, seems to have been the final tipping point for that inflection. So that rates at 1/1/23 property reinsurance renewals, they commonly went up 25% or more. And as a result of that, only in 2023 did reinsurance prices return to levels last seen in 2006. So 17 years in between those two peaks. And that momentum held up for pretty much the rest of the key 2023 renewal dates before rate increases continued, but at a slower pace in 2024. And in 2025, we started to see rates coming down a bit, though compared to historical norms, they remained at very attractive levels. But our move to a positive outlook was not only reflective of the repricing, but also of the de-risking that took place. At the same time that they were raising rates, we saw reinsurers implement significant changes in terms and conditions, including higher attachment points for reinsurance structures and narrowing of contract wording. And that was as important as the pricing, and a big part of why we believe that recent favorable underwriting trends have been more durable than past cycles. The role of reinsurers has reverted back to providing balance sheet protection and away from being used as a tool to help primary companies manage earnings volatility. So those are just a couple of the primary factors in play when we revised the outlook to positive in 2024. And by the way, we've seen the very favorable impact that this market reset had on results in 2023, 2024, and 2025, which we expect to be the third consecutive year that reinsurers produce strong returns that exceed their cost of capital. All this despite the fact that global insured catastrophe losses continue to exceed $100 billion every single year. So now, catching up to today, we saw an acceleration of property cat rate decreases at the January 1 renewals, with pricing down between 10 and 20% on average, bringing those rates online closer to the pre-2003 levels. And it's a bit difficult to identify a potential catalyst for a reversal or a bottoming of that trend, because reinsurers have generated so much capital for the past few years, and they'll be looking for places to deploy it or else return it to their shareholders. So that's pricing on the property side. Different story on casualty, where positive pricing momentum persists, but it's still fair to ask whether it's keeping pace with loss cost trends, particularly in troubled lines, including commercial auto liability, excess liability, general liability, some others, which continue to be impacted by social inflation and legal system abuse, often supported by litigation financing. And we don't see signs of that abating anytime soon. We've seen several reinsurers take casualty reserve strengthening in 2024 and 2025. Certainly possible there's more to come on that front. But it's not all bad news. The significant improvement in terms and conditions that reset following the 2023 renewals is proving to be quite durable. We have not observed significantly lower retentions or broad reintroduction of aggregate covers that are designed to provide earnings protection to the cedents as opposed to the balance sheet protection. The changes have been more focused on expanding policy wording and narrowing exclusions, and that can have a meaningful but maybe a less of an impact than broader structural changes to reinsurance programs. And while property reinsurance pricing is coming down and projected margins have narrowed, property exposures are still in general being priced at levels that suggest technical adequacy or perhaps even a bit better. So while rates are softening, we believe that the market remains fairly disciplined overall. And then finally, while excess capital can promote a competitive market environment, balance sheet strength is also favorable from a credit perspective. So in general, our view is that some of the more favorable trends that have been impacting the market, primarily property pricing, clearly diminishing to an extent, while some of the factors that are challenging the reinsurers, whether it's climate risk or an environment in the US that continues to incentivize inflated jury awards, they're not really dissipating. So in general, we see an overall operating environment where for now, we see the headwinds and the tailwinds more or less offsetting each other. And we think that view is probably more reflective of a stable outlook for reinsurers than positive.
So Greg, how does AM Best shift in the global reinsurance outlook from positive to stable reflect changes that you observed during the most recent renewal season? And which signals carried the most weight in that decision?
All right, well, the factor that carried the most weight was the decline in property pricing. As I mentioned, probably not back down to pre-2023 renewals just yet, but as I mentioned, also difficult to identify a near-term catalyst for a reversal on those downward trends. 1/1 renewals down 10 to 20% with greater capacity and more competition for higher layers than lower layers, including increased interest from third-party capital. And all that was honestly completely in line with our expectations following a relatively benign second half of the year in terms of insured cat losses. But we waited to see how the 1/1 renewals actually played out before addressing our outlook. From our conversations with reinsurers leading up to the renewals, it seemed clear that they were prepared for some downward pressure on rate. And most felt, following at least 3 years of very strong performance, and most felt that the market could absorb some softening and still remain at technically adequate levels, but no question the risk margin has declined, right? We're clearly past the peak of what many have described as a generational hard market, though still not at a bad spot at all from a historical perspective in terms of pricing. That said, there's still all the caveats that I mentioned in my earlier remarks: social inflation, litigation abuse, the continuation of elevated climate risk, et cetera.
So within that outlook change, Greg, which regions or lines of business are showing the greatest divergence in performance, and why would that be?
All right, great. Well, for the past few years, results for property cat writers, especially in the US, have been pretty robust for a couple of reasons. First, you've got the favorable pricing environment, which we've already talked about. And then for the last 3 years, at least, there haven't been too many major storms that have made landfall in the southeastern US. And those that have taken very fortunate storm paths and in some cases narrowly missed major metropolitan areas. Hurricane Milton in 2024 kind of grazed the Tampa area. And if it had taken just a slightly different track, I think the losses from that event could have been many multiples of what they actually were. There's been plenty of storm activity. It's just that the storms haven't necessarily made landfall. There were 3 Category 5 storms in the Atlantic Basin in 2025. I think that's the second highest number on record, behind 4 in 2005. Hurricane Melissa devastated Jamaica as a Cat 5 storm in October of last year, but otherwise didn't really impact the US. So reinsurers that have had a heavy Florida focus did quite well. Obviously, we had the LA wildfires in the early part of 2025, so reinsurers were concentrated there, didn't fare quite as well. There continues to be elevated ongoing severe convective storm activity, but that retrenchment away from the working layers of CAT programs, less availability of aggregate capacity, has insulated reinsurers to an extent from either individual losses of a smaller magnitude or even the accumulation of many different smaller losses. Other than that, cyber's performed very well, but we're hearing that the competition in those areas is pretty intense on both the primary and the reinsurance basis.
To what extent did capital adequacy, reserve trends, or earnings volatility influence the move to a stable outlook versus maintaining a positive one?
Okay, I'll take them one by one. Right. As far as capital goes, we considered both the good side and the bad side of the capital story. From a favorable standpoint, very strong earnings and strong performance of the capital markets as well resulted in very robust capital generation for traditional reinsurers. We expect traditional reinsurance capacity at record high levels at year-end 2025, and that's augmented by another record year of cat bond issuance in 2025. So total dedicated reinsurance capacity, traditional balance sheets, plus third-party capital, we expect to enter 2026 at an all-time high, comprised of $540 billion of traditional reinsurance capacity and ILS capacity of $120 billion. So that's capital on an absolute basis. On a risk-adjusted basis, risk-adjusted capital, at least as measured by best capital adequacy ratio, or the BCAR, we also expect to end 2025 at or near record levels. So the less favorable side of all this capital is that it can lead to increased competition. Underwriters are looking for places to deploy capital. It can lead to overly aggressive competition. You also mentioned reserve adequacy. Yes, certainly concerns about potential volatility. So far, the issues that we've seen have been more so seen on the primary side than reinsurers, but they certainly haven't been immune. Seen several reinsurers take casualty reserve strengthening in both 2024, 2025. Overall, maybe reinsurers might be a little bit better positioned than primary companies in terms of addressing some of the troubled lines. They have the flexibility to avoid classes like commercial liability if they see issues there. So that's what I have to say on that. Earnings volatility, I guess I'd split my answer into two parts. Did the outlook change reflect observed earnings volatility? No, we are changing, but it does reflect potential future earnings volatility, right? We took our positive outlook off of the sector following what we expect to be the third consecutive year of very strong performance. But that may seem counterintuitive, but an outlook is not a report card of what happened over the last 2-3 years. It's meant to be perspective in nature. So it's reflective of our view that reinsurers are going to be increasingly challenged to maintain recently very strong performance.
Okay, Greg, last question before we get to our guests. How should cedents and investors interpret the stable outlook in practical terms? Like what behaviors or outcomes would prompt another outlook change?
Okay, I'd say our view is that the reinsurance market dynamics are trending back closer to a state of market equilibrium where you wouldn't necessarily characterize it as a buyer's or a seller's market. Most reinsurers likely feel they're providing capacity at levels that are supportive of margins that would allow them to cover their cost of capital, but those margins are clearly narrowing, at least on the property side. And on the casualty side, still getting rate, but we'll have to see how the recent accident years develop over time. And then what would cause us to change our outlook? So directionally, I think you'd have to say in the near term, there's more downside risk than a likelihood to return to a positive outlook. So in terms of what might lead us to a negative outlook would be signs of erosion in market discipline, irrational pricing, meaningful relaxation in terms and conditions, or separately indications that recent accident years have been underpriced, particularly in longer tail lines, leading to reserve volatility and erosion of balance sheet strength.
Great presentation. Thanks, Greg.
Thanks.
Renaud, how would you describe the current state of the global reinsurance market following the most recent renewal season, and what surprised you the most?
Well, let me start with a point which will echo both of our panelists' respective remits. Greg just mentioned the buildup of capital on reinsurers' balance sheet over the past few years. It's not to be denied, and that contributes to the supply of capital. And that supply is obviously amplified also by the capacity provided by ILS players, and we'll hear shortly from Aditya. So definitely the supply of capital is on the rise. But what matters is that facing this supply of capital, you have a demand of capital, demand of capacity, demand of protection, whose growth is running unabated as well. The world is definitely becoming a riskier place. our clients, insurers, are in need of certainty, predictability, visibility, which means that they are looking for the services provided by reinsurers to actually bridge that gap between uncertainty in the world and the certainty that they need for the running of their own business. So I would characterize the state of the market as a fair and healthy balance between supply and demand of capital. And I also think that when looking at the state of the market, it's very important to take into account, obviously, the cyclical dynamic, and there's definitely a cycle at play, but also to take stock of the secular trends. And what is for sure is that given all the threats that are materializing and that are on the rise, both natural events and man-made events, the demand for protection goes only one way, which is up. And so that secular trend is definitely supporting the reinsurance market. As to your question about any surprise, well, I would quote Greg. Greg, you mentioned that most of the reinsurers you review and you work with were actually well prepared for that turn of events. And I could say the same from my own experience. I think that, we had planned for this. And one of the benefits of being really in the tent with our clients, having not only a very close dialogue with them, but also a strong partnership, is that we are able to anticipate together what will be their needs and how the market will evolve as a consequence.
Aditya, from an ILS investor perspective, how would you characterize the health of the global reinsurance market coming out of the latest renewal season?
Hi, John and Greg. Always a pleasure to be with you, and thanks for having me. So I think from an ILS perspective, our industry's lifespan is much shorter than the average reinsurer who's looking back several decades. So if you think about the ILS market, it's really about 20 to 25 years old, and ILS investors have probably been through 2 or 3 cycles at this point, at least 2. I would actually say the perspective now, having gone through a couple of cycles and having seen a period like 2007 to 2014 or 15 with almost no losses, having seen a period of very, very low interest rates and very, very low risk margins in the property cat market, but also having seen, as Greg appropriately mentioned, a generational hard market like 2023, I think the investors now have excellent bookends on how to look at this market. And I think the reaction to what occurred at 1/1/26 was actually a very measured, healthy, and appropriate reaction. My estimation of what investors did, certainly not to be specific to each one, but as a general matter, was to keep capital roughly flat in the sector, maybe a little bit more, marginally higher. Greg, as you said, cat bonds, because of their excellent track record over the last quarter century, have had inflows of capital. But overall, I would say ILS capital grew slower year on year than it did in prior years. And I think that's actually a very healthy, self-regulating mechanism. And some of the topics that the investors brought up are exactly the topics that you are enunciating in terms of your outlook, which is pricing, terms and conditions, looking forward, what could cause risk margins to improve or degrade. I've actually, over the last decade, seen increasing level of sophistication, and I would say a very, very healthy response to what we saw at 1/1. All this with the backdrop, John, that I think it's important to sit back and realize we're in a fundamentally very strong market for reinsurers, we are in a very fundamentally strong market for insurers. Most insurance companies, most cedents are getting excellent coverage at a fair and acceptable price to reinsurers. It's not the pendulum position of 2023. It's certainly not a soft market, but I would say economics are very well balanced, and external investors see that and recognize that.
Renaud, what strategic priorities are top of mind for a global reinsurer as the market transitions from a hardening phase to a more stable environment?
Well, John, I would say that our strategic priority, whatever the market conditions, in all weather, is actually to support our clients and make sure that what we bring them is relevant and actually an enabler to their own success. And this is definitely the yardstick which we use to gauge the impact that we have. So it's a key strategic priority. And in this market, we want to make sure that the solutions we provide continue to be as efficiently priced as possible. And this is how we fulfill the role which Greg mentioned earlier, which is a role of balance sheet protections for our cedents and all of our clients and business partners. I do believe that in these market conditions, which become more selective and you could argue a bit more challenging to navigate, this is when you can make a difference. And I think it's fair to say that it is in that kind of market environment that the best underwriters come forward.
Aditya, how are investor expectations evolving around returns, volatility, and diversification benefits as the market matures into 2026?
Thanks, John. I think, for most global investors, whether they're invested directly into reinsurance companies or into ILS funds, there is almost always an absolute comparison, i.e. ourselves versus ourselves. How did we do relative to ourselves last year? How did we do relative to a cycle, ROE? And then there's a relative comparison versus other asset classes. And I think the more those two diverge, the more interesting the perspective becomes for investors. So, how are they seeing this evolve over the next year with respect to returns, volatility, as you said? In terms of returns, I think investors are very clear-eyed about what to expect next year. Almost all ILS managers provide pro forma outlooks, pro forma portfolios that very clearly spell out how pricing and terms have impacted a new portfolio. I think they're pretty clear-eyed about that. Volatility is a very interesting question. We are a non-correlated asset class. And from what I know of other markets, from my observations of other markets, especially what we saw in the fourth quarter of 2025, was that valuations, broadly speaking, in the equity market and spreads in the fixed income markets went to levels where a 10% decline, for example, in reinsurance was a much more favorable outcome than accepting the spread tightening in a certain fixed income asset class or a 29 times forward PE, for example, in the equity markets. And so the relative comparison actually made us look very good. The absolute comparison, as Greg said, might have been off 10% or north of that. So I think there are a lot of considerations. My guess is going forward, the same considerations will apply. But as I said, if you look at our sector, and most analysts would say roughly mid-teens return is reasonable for most reinsurers next year. I think on a relative basis, that looks excellent.
Greg, how are macroeconomic factors, things like interest rates, inflation, and geopolitical risks, factoring into AM Best's view of reinsurer balance sheet resiliency in 2026?
Okay, so As far as higher interest rates, the risk of economic inflation is compounded by uncertainty of the potential impact of tariffs, maybe trade wars under the Trump administration. It's a consideration, right? I think it's important to acknowledge also that the industry historically has managed economic inflation and interest rate risk fairly well. I think it's an exposure it understands and can adapt to an extent. Was maybe a bigger concern a few years ago when we were coming off a very prolonged period of historically low interest rate environment until we saw interest rates spike in the second half of 2022. Fed funds rate tripled in response to inflation fears. We saw resulting unrealized losses in fixed income portfolios, which put a temporary dent in many reinsurers' capital positions. But at the same time, in anticipation of potential rise in interest rates, reinsurers have protected themselves. Their investment portfolios are pretty short durations. So the losses, or at least a lot of the losses, recovered fairly quickly. And then they benefited from higher reinvestment rates on their portfolios, which often doubled or tripled. So the higher net investment income has been a nice tailwind for reinsurers. Now, I mean, it seems more likely that economic inflation might be more under control, nothing for sure. And rates more likely, well, at least not likely to triple again, right? So economic inflation remains a consideration for sure, but maybe not at the very top of the list as far as risks to reinsurers. Now, social inflation is another story, and unpredictable jury verdicts are expected to continue to fuel social inflation, particularly in the US, where tort reform has been uneven, and whatever positive impacts may result are likely not to manifest for a number of years. It's more difficult for the industry to get their arms around this exposure, and it's something that reinsurers are going to have to very carefully manage, and it was one of our primary considerations when we revised the outlook to stable from positive. And then in terms of geopolitical risk, tensions around the world continue. Issues are going to pop up occasionally. The Russia-Ukraine conflict had a big impact on marine, aviation, and trade credit markets. Where reinsurers might be at an advantage versus primary companies is that global reinsurers aren't typically committed to a particular specific geography or line of business. So if there's a region of the world that's experiencing elevated economic or political unrest, they can fairly quickly adjust their portfolios to curtail exposure in those areas. I mean, a systemic event that would cause issues on a global basis, that would be a different story.
Aditya, what role do non-traditional or emerging risks play in shaping portfolio construction today, and where do you see the most opportunity?
John, the investors in general, institutional investors, and certainly investors in the ILS space, are very deliberate about the risks they are accepting for financial gain. So, for example, when the industry went to pension plans, a decade ago, 2 decades ago, the fundamental pitch of our asset class was property catastrophe and physical risks, when they're securitized the way we do them, are non-correlated to their broader portfolio. When you talk about non-traditional or emerging risks, for example, let's say cyber, let's say casualty, even on a more basic level, or specialty risks like terrorism, those then introduce correlation. So cyber, terror, casualty are economically correlated to other securities in a pension plan's portfolio, in a sophisticated investor's portfolio. I would say my observation, John, is over the years, investors are not averse to accepting the risk, but they are very clear that they are accepting the risk. In other words, they are consciously taking it. I'll give you an example. When COVID happened and COVID losses showed up in property catastrophe, reinsurance, excess of loss contracts, investors were surprised by that. I think, on the other hand, had they understood that communicable disease could impact property cat excess of loss portfolios, they would have accepted it and figured out, are we getting paid for this or not? But it's not that non-traditional or emerging risks cannot be included in portfolios. I think it's incumbent upon our industry to be very specific about the role that each portfolio is playing in that investor's overall allocation strategy. And I think if there is correlation, it's our job to point out, hey, you're accepting correlation. Here's how you're getting paid for it. You're getting leverage in the form of asset leverage. You're getting float, low-cost float. You're funding your assets cheaper, as opposed to the cat pitch, which was, a hurricane hitting a house has nothing to do with interest rates. And I think the non-traditional risks that are top of mind these days, I would say cyber is probably top of that list. Casualty is close to the top of that list, GL, and terrorism and specialty lines, quote unquote specialty lines. We hear the most, but we're a pure property catastrophe writer, but those are the lines we hear the most about. And I don't think we're too far away from seeing that included in many of our investors' portfolio going forward. And in fact, there are some excellent companies that source these risks for their investors today.
I had a follow-up question on that, if it's okay. Yeah. So Aditya, in terms of alternative capital willingness to commit capacity to longer tail risk, you mentioned general liability. What do you see as a major remaining hurdles to that? Is it an understanding of the nature of the risk they're assuming, or is it more an exit strategy or that needs to be solved, or something else?
Yeah, Greg, actually, I would say casualty sidecars, in a manner of speaking, are some of the most popular new vehicles in the market. So it is catching on. Maybe what I could say is, why now? Why not 5 years ago? I think some of our competitors and fellow reinsurers in the market have spent some time perfecting the technology to get capital in and out of vehicles. As you know, casualty, long tail doesn't mean finite. In some occasions, it certainly also doesn't mean known length of the tail. It can be an unknown long tail. And, investors hate uncertainty and they hate surprises. And some of these longer tail lines have both. So, very generally, reinsurers have spent some time coming up with technology that reduces uncertainty and reduces volatility. And I think once those hurdles are cleared, i.e., what do you do with a runoff portfolio? You have this ramp up period and then you have a runoff period. And reinsurers and ILS managers are starting to figure out various ways to attack that problem and succeeding. And that's, I think, led to some of the inflow of capital. The thing that I think is the obvious encouragement for these investors is the asset leverage that they're getting in a favorable interest rate and spread environment. And when you can lever your capital a couple of times, it's obviously attractive to many of these investors. The most obvious example is actually life reinsurance. But certainly this is happening in non-life reinsurance as well.
Along those lines, Renaud, what role does innovation, whether in analytics, product design, or risk transfer structures, play in sustaining performance in the year ahead?
Well, great question, John. I think we have to recognize that innovation comes in at least two forms. The first one is, what is widely viewed as being a creative innovation. But there's another dimension to it, which is also, given the fact that the world is evolving very quickly, innovation just to keep pace with reality. And so, across the various dimensions which you hinted at, what we believe is that given since the beginning of the century, risks have evolved very significantly, we need to understand them by assessing them very thoroughly. And this is why at AXA XL Reinsurance, we invest a lot in research. We have a partnership with Cambridge University, which has been running successfully for several years now, more specifically with the Cambridge Center for Risk Studies. And to us, it's very important to take this fundamental view of the risk. But also echoing what Aditya was just mentioning about policy wording, it's also important to reflect the evolution of the underlying risk into the treaty language. For instance, you have to take stock of the fact that the drivers of accumulation and aggregation are not the same as they were a quarter of a century ago. And so this is why all clauses related to time and distance have to incorporate some degree of innovation into it. Once again, this is innovation to keep up with a fast evolving world and many threats looming around us. One last point, about innovation in the risk transfer structures. I think, Aditya, you just referred to excellent companies that source the risks that investors want to get exposure to. We strive to be one of these excellent companies, and we have very significantly grown our ILS franchise over the past few years, establishing very successful partnerships across many constituencies with very loyal investors. And I think the best metric we have to assess whether that innovation is fruitful is actually the fact that our investor partners allocate and commit to us a growing amount of AUM year after year. So this is really innovation in action and supporting our ability to deliver the most relevant solutions to our clients.
Renaud, how are client expectations changing, and how does that influence decisions around capacity development and partnership structures?
Well, John, there's one thing which is definitely not changing and which echoes my earlier mention of secular trends. It's the fact that at board level, in C-suites, all senior decision makers actually want to cover against tail risks and benefit from this balance sheet protection, which we were discussing earlier. So I would say that's definitely constant or even amplified, actually, if anything. And the fact that at a cyclical level, over the past couple of years, maybe losses have been skewed more towards the attritional part and occasionally below retentions, has not altered in any way the sheer consciousness that all decision makers have of these big tail events, which can be really life-threatening and existential events for insurance companies, for all carriers. And so there's definitely a strong desire to get cover for that and to call on reinsurers. There's one additional point which stands out in my view, which is that clients now increasingly want to work with partners with a lot of trust and goodwill beyond the capacity provided, with a common corporate DNA. So I would say that corporate ethos and corporate culture matter at least as much as the ability to provide capital. And in that respect, having demonstrated a willingness and an ability to pay, and more specifically to pay out claims, which is after all what we are here for, really sets apart some reinsurers, and we believe we are one of them. And I think it is really in these challenging moments, in testing times, that you can prove the robustness of a partnership and actually assess whether reinsurers live up to the commitment that they formed initially upon inception of the treaty.
Greg, are you seeing evidence that underwriting discipline is holding firm despite competitive pressures, or are there any early signs of margin erosion?
I think broadly we do believe that underwriting discipline is being maintained. We have not observed any significant structural changes in reinsurance programs. For an example, return to working layers of cap programs. As mentioned, while pricing is off historically high levels, it's still very attractive versus historical norms. Pricing is rational. I think if you're looking for maybe signs of cracks in reinsurers' resolve on the margin, there has been some reemergence of capacity for aggregate covers, which can be an early indicator of a soft market cycle. But just anecdotally, the cedents who have executed ag covers have tended to be buyers that tend to have a lot of leverage in the market, or the programs themselves are structured to take effect only at more remote attachment points. So again, more designed as the balance sheet protection versus earnings management. And then during our discussions with reinsurers, some have mentioned that multi-year treaties are available again here and there, and multi-year deals are typically more associated with soft markets. Wouldn't categorize either as a bright red flag quite yet, but certainly bears watching as they could be leading indicators of a soft market cycle.
Renaud, how do you balance growth ambitions with underwriting discipline as competitive pressures begin to reemerge?
Well, John, that balance is actually embedded in everything we do and how we operate. We have a very disciplined underwriting and pricing policy and a long-term approach to risk. We really take the long view. Our philosophy at its core is really that our underwriters have to do what they believe is right. So they have no pressure to grow. If there's an opportunity to support more our clients or to support more clients, either one of them, under conditions which are adequate at least, then we are obviously extremely happy to do so. But we only do so if the right conditions are met. We have a detailed renewal planning, which is bottom up, down to the treaty level. We validate all pricing metrics, and we follow very clearly the rate adequacy and the expected loss ratio. And so all of that helps us be successful whatever the market conditions, and this is really what we strive to do, and it gives our underwriters confidence to transact. What I would add is that all of our clients have a vested interest in us making the right calls and ultimately being profitable. And I think this is one of the beauties of the reinsurance ecosystem, which is that interests are aligned. Every stakeholder has skin in the game, and ultimately all fates are intertwined. So we really like that alignment of interest with our clients. We win with them. Occasionally we lose with them, but over the long term, we know that both parties and both sides of the trade actually win from it. And it's obviously also in our clients' interest that we are thriving and profitable, because the profits of today actually fuel the robustness of our balance sheet tomorrow, and ultimately our ability to pay when we have to. So I think there's a direct link between the flow of profit and ultimately the capitalization of reinsurers. And capitalization of reinsurers, I mean, being on an AM Best panel, I don't need to stress it, but as reflected in a credit rating, is probably the best guarantee that our clients can have of our ability to continue to serve them in the long run.
Aditya, what signals from reinsurers or cedents give you confidence that underwriting discipline will persist into 2026?
John, there's a couple of things. I think, first of all, the percentage of claims that are being paid by reinsurers of global industry losses are at a record low. I think this is reflective of the change in terms and conditions and attachment points that Greg referred to. I would say those changes, terms and conditions, structural changes in contracts, are so fundamental to reinsure profitability, almost, if not certainly on par with pricing, but maybe even more valuable. That's number one. And as Greg said, and as we observed, as many reinsurers have observed, there was actually discipline around preserving terms and conditions and structural provisions at a place that's pretty close to 23, 24, 25. You don't have to try very hard to compare 1/1/26 to 1/1/24/25 when it comes to the tightness of contracts. That does an incredible amount of work for a reinsurer in protecting the integrity of the balance sheet and the integrity of profits. Number two, I think capital management and capital return is now an accepted form of cycle management. and we've already seen it. I think you can, in the public companies at least, fair amount of share buyback activity has occurred in our sector. I see that as a really encouraging sign that reinsurers are right-sizing their capital instead of force deploying that capital back into the market. They're choosing, from a corporate finance standpoint at least, the most accretive transaction, which is giving it back to shareholders. And number three, very few, if any, new startups have come into the market. We've seen the class of '01, the class of '05, but no class since then that's organized in the way that we used to see them, for the last 2.5 decades. So I think actually capital discipline as well as contractual discipline, to me, are the most encouraging signs for reinsurers. And actually, on the ceding side, the fact that we've ended up in an equilibrium where cedents feel that their risk is being adequately covered, reinsurers feel that they're being compensated in an acceptable fashion, gives me a lot of confidence that actually we'll keep this stasis position for some period of time.
What strategic shifts do you expect ILS managers to make over the next year as market conditions normalize?
I think it's very important for the whole industry, maybe not just ILS managers, but discipline. The reason we have cycles in our sector is people's discipline starts to fade. And I think the strategic shift will be an attitude towards capital, which is the short-term view is, if I let capital go, I won't see it again. I think the long-term view, as some of the best companies in our sector have demonstrated, is if I manage capital appropriately, I'll actually get it back when it works the hardest. And I think the best companies in our sector have demonstrated this over and over and over again, and they've been incredibly successful doing this. But my hope actually is that both underwriting discipline and capital discipline become functions of strategic playbook of the ILS industry. And because of our capital structure in the ILS industry, we tend to be very, very focused on underwriting discipline. We're a simple capital structure. We just raise money from pension plans and other institutions. We don't have debt normally, et cetera. But I think blending those two simple but difficult to execute principles into your strategy is the challenge I would say our industry has. And that's not an ILS comment. It's the whole industry.
Thank you, Aditya. Great presentation today. Renaud, which lines of business or regions do you believe will be the key drivers of reinsurer performance in 2026?
Nice try, John, but please forgive me for not revealing what the secret sauce might be. What I would share with you today, though, as an insight, is that we do believe that a balanced mix, be it by product or by geography, is key to success. I think that, Greg, you mentioned earlier the fact that the dynamic is pretty contrasted between some lines, and you called out, for instance, casualty and cyber. All of that speaks to the importance of having really a diversified book across all products and all regions. And the fact that we at AXA XL Reinsurance operate as one company, regardless of geography, definitely enables us to serve clients wherever their needs arise and under whatever form they arise. And I believe that our clients and more broadly brokers and our business partners value this consistency of access and this ability to be very agile in the deployment of our capacity to make solutions available to our clients.
Looking forward, Renaud, what would a successful 2026 look like for the global reinsurance sector from your perspective?
Well, John, very often when my clients ask me how I'm doing, I just return that reply, which is, well, tell me how you're doing, and you will have the answer, because my mood is very much aligned on the one of our clients. And so the yardstick for success in 2026, like any other year, will be whether our clients are happy and whether we keep earning their trust. It's definitely through the lens of our clients that we appreciate our own trajectory.
Greg, looking ahead to 2026, what indicators will AM Best be watching most closely to assess whether the sector is strengthening or plateauing?
Sure. Well, like the rest of the market, we'll be watching to see how pricing indices continue to develop, whether property rates continue to trend down and get back to those pre-2023 levels or lower. If there are one or more large cat events that see reinsurers absorb a large share of the losses, is that going to be enough to turn the market again or even stabilize it? And this is going to track very closely with some of the observations that Aditya made earlier, but observing capital management trends, whether reinsurers continue to be responsible stewards of their shareholders' capital, or if they pivot to an overly aggressive growth mindset. We'll be tracking the emergence of new capital coming into the industry, either in the form of new company formations, and probably less likely, as Aditya mentioned, we saw very little in the way of new company formations, even in the middle of this generational hard market. And part of the reason for that was the industry wasn't in particular need of new capital. Then third-party capital, and how is that trends with respect to that? I think that's much more likely to continue to grow at a healthy pace. And as importantly, how is that third-party capital behaving? Is it competing directly with rated balance sheets or acting more as a strategic partner, filling in gaps? How is it being priced? And then we'll be very carefully looking out for meaningful deterioration in terms and conditions. Maybe most troubling would be a movement back towards lower retention or higher limits on reinsurance treaties.
Greg, we had a lot to take in here today from Aditya and Renaud. What do you think the big takeaway is for our people watching today?
Sure. I think from our standpoint, the reinsurance market is, for now, in a pretty healthy place overall. Even if we're clearly past the peak of the last hard market cycle in property reinsurance. And I think two critical areas to watch going forward are whether reinsurers become victims of their own recent success and become overly aggressive deploying the capital that they've amassed in a market where attractive opportunities are going to become more challenging to identify. That's the first thing. And then second, whether the industry can successfully navigate the complexities of the casualty space and mitigate reserve volatility.
Thank you, Greg, and thank you, panelists, one and all, for an outstanding presentation here today. We'd like to let our viewers know that we will have a full replay of this briefing posted within the next day or so. We'll have a full transcript out within the next week or so. For AM Best, I'm John Weber.
Looking to get the full attention of the insurance industry? We have the platforms that will do just that. Whether it be AM Best TV, AM Best Audio, Best Review Magazine, or Best Day. Find out more by calling AM Best Advertising Sales at 908-439-2200, extension 5399, and have a great day.